Welcome to Griffonomics. So, um, how exactly does a company convince Wall Street that it's still worth this premium, high-flying tech valuation of 29 times earnings when, its actual top-line revenue growth is stuck at a really sluggish 3 to 4%?
Yeah, it's a massive paradox because normally a multiple that high, it requires hypergrowth. You'd expect a company to be just doubling its top line, capturing brand new markets at lightning speed.
Exactly. But today, we're looking at what I think is the ultimate financial high-wire act. We are taking a deep dive into Align Technology, the company behind Invisalign.
Right. And we've got a ton of mid-2026 sources for this analysis. We're looking at their Q1 earnings, the 10K, proxy statements, and some really revealing recent investor conferences.
And the mission for this deep dive is to evaluate this massive strategic pivot they're undergoing, because they are systematically trying to defend that huge valuation through basically intense operational cost discipline and some very aggressive capital deployment.
Yeah, they are fundamentally transitioning from this growth at all costs tech darling into a highly disciplined, efficiency engineered cash cow. They are completely altering the economics of what they sell.
Okay, let's unpack this. Because the most glaring piece of this pivot, it jumps right out of their Q1 guidance. They told investors to expect a 1 to 2% decline in their clear aligner average selling price, or ASP, for 2026.
Which is usually a massive red flag.
Right. If your listener holding shares in a company and they casually announce, hey, we're going to make less money per unit sold this year, your immediate thought is probably that they're losing pricing power, right? Like they're just defensively discounting to fight off cheap competitors.
Yeah, but the underlying mechanics in the documents tell a totally different story. This isn't a discount. It's a deliberate structural mix shift. So part of it is just geographic tier expansion.
Like pushing into India and Brazil.
Exactly. They are seeing double-digit growth in those emerging markets, and the baseline list prices for medical devices there are naturally lower. So statistically, that just drags the global average down.
Sure, that makes sense. But
Yeah.
there's a bigger product shift happening too.
Oh, a much bigger one. They are heavily pushing these down-market configurations to doctors, specifically the doctor subscription program, or DSP, and their zero AA packages.
And zero AA means no additional aligners, right?
Correct. So historically, Align's whole thing, their flagship product, was the comprehensive unlimited package. A doctor paid a massive upfront premium, but that fee covered years of treatment.
Like an all-you-can-eat buffet of plastic trays.
Yeah, literally. If a patient's teeth didn't track perfectly, Align would manufacture and ship unlimited refinements, just brand new batches of custom aligners, totally for free until the case was done.
Wow, okay. And now?
Now they are pushing these streamlined, lower-cost packages. The doctor buys the initial set of aligners, and that's it. The transaction is over. If the patient needs touch-ups 6 months later, the doctor has to open their wallet and pay extra.
I want to test an analogy here. Is this basically the airline industry's basic economy playbook? Like an airline charges you less upfront for the seat, so their average ticket price looks lower. But because they stripped out the checked bag, the seat selection, the snacks, their actual profit margin on that cheap ticket is way higher.
That is the perfect analogy, but honestly, it's even more lucrative for Align than it is for an airline.
How so?
Well, an airline still has to fly the physical heavy plane, whether you bought basic economy or first class, right?
Right.
But when Align strips out those back-end refinements, they completely eliminate a ton of future liabilities.
Oh, like they don't have to do a second round of digital treatment planning.
Exactly. They don't pay software technicians to redesign the smile. They don't have to fire up the 3D printing lines again. And they don't pay for global shipping a second time.
That's huge.
It is. Because these downmarket products have virtually zero operational overhead after that initial sale, they actually yield massive 75 to 80% gross margins.
Okay, so they're collecting fewer total dollars on the front end, but they are keeping significantly more of those dollars as pure profit.
Right. It's pure efficiency.
But to make that work, to replace the revenue from the expensive packages, you have to sell a massive volume of these basic ones. Which brings us to their institutional moat, because the customer base buying these aligners is shifting really fast.
Yeah, we have to look at the macroeconomic friction that's just slamming North American retail dentistry right now. The independent neighborhood orthodontist is really struggling.
Because patients are balking at the price tag. Yeah. If you get a quote for a $6,000 elective treatment right now, with inflation up and interest rates where they are, you're going to pause. Traditional credit card financing is just incredibly painful.
Exactly. Independent doctors just cannot generate the foot traffic they used to. So to survive this, Align is anchoring its entire volume strategy to DSO's dental support organizations.
And for anyone unfamiliar, DSOs are these massive, usually private equity-backed corporate networks that buy up hundreds of local dental clinics.
Right. And according to the Q1 data, DSOs now make up roughly 25% of Align's total global mix, and that segment is growing at double-digit rates.
Align is definitely actively buying that institutional loyalty, too. The 10K shows they've taken strategic equity stakes in some of the biggest networks. They deployed, what, $150 million into Heartland Dental?
Yep, and another $40 million into Smile Doctors. And in return, these massive DSOs act as a guaranteed volume floor for Align.
Because unlike an independent doctor who kind of just sits and waits for a patient to ask for Invisalign, the corporate DSO mandates this really aggressive sales strategy. Management calls it the active conversion playbook.
It's a fascinating playbook. So Heartland Dental, for example, they just upgraded their entire fleet of clinics to Align's newest iTero Lumina scanner. And their corporate policy dictates that every single patient gets their mouth 3D scanned.
Regardless of what they came in for, like even just a basic cleaning.
Even for a cleaning, you sit down, they scan you, and they throw a high-definition simulation of a perfect, corrected smile on a monitor right in front of your face.
Oh, wow. So it creates this instant visceral demand.
Exactly. But the more critical piece is how they bypass that $6,000 macroeconomic barrier you mentioned. Align partners directly with integrated financing platforms like Healthcare Finance Direct.
So while you're staring at your simulated new smile, they run an instant pre-qualification.
Right there in the chair. They don't present you with a scary $6,000 lump sum. They present a super digestible monthly payment of like under $100.
So it basically turns a massive capital expense into a localized subscription for the patient. But here is the thing. Funneling all these new patients through corporate DSOs creates a new bottleneck.
The hardware.
Right. The clinics actually need the physical iTero scanners to scan everyone. Yet, when I looked at the Q1 infrastructure numbers, systems and services revenue actually dropped 12.1% sequentially.
Which looks really bad on paper.
Yeah. If the entire active conversion playbook relies on scanners and hardware sales are dropping double digits, how is that not a massive blinking red flag for the whole growth engine?
I get why it looks alarming, but it's actually a tactical shift, not a permanent capital expenditure freeze. The issue again comes back to the cost of capital. An independent doctor is not going to take out a high-interest loan to buy a brand new top-tier scanner outright right now.
So what's management's fix?
They're pivoting their distribution models. They are heavily promoting scanner wand upgrades for existing machines. They're pushing certified pre-owned used units, and they are rolling out these flexible leasing and rental programs.
Which the documents show renting is already the norm in markets like Brazil and China anyway. It really reminds me of the video game console industry.
Oh, the razor and razor blade model.
Exactly. Sony will gladly sell you a PlayStation at a loss, or lease it to you dirt cheap, because the console is just a Trojan horse. They know that once that box is sitting in your living room, you are locked into buying their high-margin digital games for the next 7 years.
And Align's internal data supports that exact strategy. Their metrics show that just migrating a practice from messy traditional putty impressions to a digital scanner naturally lifts clear aligner volume.
But the craziest stat was what they call the force multiplier.
Yes. When a practice installs an additional scanner, like a second or third unit, it yields a 4 times improvement in overall case volume. The scanner is just the bait.
Right. If offering a low-margin, zero-interest lease is what it takes to get that second scanner into a clinic, Align is going to take that deal every single time just to secure the recurring 80% margin clear aligner revenue.
Absolutely. The scanner just catches the fish. The aligners are the profit center.
Okay, so if the scanner is the video game console, we need to talk about how they are actually manufacturing the games. Because to squeeze the maximum profit out of those aligners, Align is completely overhauling their factory floors.
This is where we get into the Cubicure acquisition and this massive shift toward direct fabrication.
Let's break that down because the legacy way they used to make these things sounds incredibly inefficient.
Oh, it was terribly wasteful. For decades, to make a single set of aligners, Align first had to 3D print a physical, hard plastic mold of the patient's teeth.
Right, an actual replica of the jaw.
Yeah. Then they took a flat sheet of thermoplastic, heated it up, and vacuum formed it over that mold. And after they cut the clear aligner out, That original mold was simply thrown away.
Wait, thrown away. So if you have millions of aligners being made, that means millions of disposable plastic molds are just heading straight into a landfill.
Millions of them. It was an operational nightmare, but it was really the only way to scale the technology back in the early 2000s.
But this Cubicure acquisition changes that.
Completely. It allows them to pioneer direct 3D printing of the aligners themselves. They are eliminating the mold entirely. And they are slating this to scale up across 2026 and 2027.
That is going to redefine their unit economics.
Yeah.
I mean, direct fabrication eliminates, what, 80% of the plastic resin waste?
Roughly 80%, yeah. The cost savings on resin alone are going to be massive. But honestly, the clinical implications are what I found really fascinating in the sources.
Here's where it gets really interesting.
Yeah, so when you vacuum form a flat sheet of plastic over a mold, the plastic inevitably stretches, right? So the thickness becomes totally uniform. Or worse, it gets unpredictably thin in areas that required a lot of stretching.
Which limits how much force it can apply to a stubborn tooth.
Exactly. It limits the clinical efficacy. But direct fabrication solves this. By 3D printing the aligner directly, basically drop by drop, the software can program variable wall thickness into a single, continuous piece of plastic.
So if, like, a specific molar needs a really complex rotational force,
the printer just builds a thicker, more rigid wall around that exact tooth to apply the pressure, while keeping the rest of the aligner nice and thin for the patient's comfort.
wow, that completely widens the gap between Align and these cheaper generic competitors who are still stuck using legacy vacuum forming. I mean, it improved the medical outcome while simultaneously driving down the factory costs.
It's a brilliant piece of efficiency engineering.
Okay, so the factory floor is getting leaner. But let's shift gears to the financial forensic side of things. How is management handling the broader corporate balance sheet? Because I was looking at their SG&A, their selling, general, and administrative expenses, and Q1 featured this massive $30.6 million legal settlement expense.
Yeah, the legal drag. Management's treatment of that fee is just a classic piece of corporate financial engineering. They completely stripped that $30.6 million out of their non-GAAP operating metrics.
So they're essentially asking Wall Street analysts to just look the other way.
Basically. They categorized it as this one-time, non-recurring penalty, rather than admitting it might be a permanent bloat to their overhead run rate for the rest of 2026.
And honestly, Wall Street usually plays along with that, as long as the core engine of the business is generating cash. And Align's balance sheet is an absolute fortress right now. I mean, they are sitting on over $1.05 billion in cash, with zero debt.
Zero debt in this interest rate environment is a huge advantage.
It really is. And what they are doing with that cash is where the whole attempt to protect that 29 times multiple really comes into focus. They executed a $466 million stock buyback in 2025. And then in May 2026, they launched a fresh $200 million open market repurchase program.
With another $800 million still authorized and waiting in the wings.
Yeah, it's incredibly aggressive.
And that sheer aggression of returning capital is intimately tied to the recent activist stake taken by Elliott Investment Management.
Yes. Elliott Management. Activist hedge funds love this kind of setup, right? They look for companies generating massive free cash flow, but who maybe lack the hyper top-line growth to keep the stock price up naturally.
Exactly. The playbook is simple. You force management to engineer a financial floor.
Let's break down the actual math of that playbook for the listener for a second. Right. So earnings per share, or EPS, is just your total net income divided by the number of outstanding shares.
Right.
So if your top-line revenue is only growing at 3%, your net income probably isn't exploding.
Yeah.
But if you spend hundreds of millions of dollars buying back your own stock, you shrink the denominator. The number of shares goes down, so the earnings per share mathematically goes up.
Even if the actual underlying business is relatively stagnant, you are artificially manufacturing growth on a per-share basis.
It's financial gravity manipulation.
It really is. And by guiding to a massive 23.7% non-GAAP operating margin and constantly using that cash fortress to retire shares, Align is keeping their EPS growth high enough to appease Elliott Management. They're just buying time.
Keeping the stock price stable while they wait for inflation and interest rates to finally drop, which will hopefully stimulate organic consumer demand again.
That's the goal. It's a brilliant financial defense mechanism.
But they are not operating in a vacuum. There are massive external forces actively attacking their moat, and management was surprisingly candid in their Q2 guidance about some pretty dark geopolitical clouds.
Yeah, they explicitly flagged ongoing military action in the Middle East as a highly unpredictable variable for the rest of the year.
How does that directly hit a line, though?
Freight logistics. They noted it has the potential to actively disrupt global shipping lanes. You have to remember, a line relies on moving physical plastic aligners and these heavy IDRO scanners across borders every single day.
Oh, right. So localized conflicts can cause immediate spikes in supply chain cost.
Exactly, which eats directly into those beautifully engineered profit margins we were just talking about.
And beyond the macro supply chain threats, the actual B2B commercial battlefield looks brutal right now. Are they essentially just playing global whack-a-mole with competitors?
Pretty much. They are fighting a global multi-front war for clinic space. So on the premium end, you have massive dental conglomerates like Envista pushing their Spark aligners.
And Spark is targeting the high-end cases, right?
Yeah, Envista leverages these really deep legacy relationships with top-tier orthodontists to poach Align's most complex, highest-margin specialist cases.
Okay, so that's the premium threat. What about the general practitioners?
On the other end of the spectrum, you have conglomerates like Dentsply Sirona pushing SureSmile and the Straumann Group pushing ClearCorrect. They are deploying a bundled value pricing strategy.
Bundled pricing, like a cable package.
Basically, they approach a dentist and offer heavily discounted clear aligners, but only if the clinic agrees to buy their dental implants and crowns as well.
Oh, wow. And Align operates a standalone model. They only sell aligners and scanners.
Right, so Align cannot offer those cross-category bundles. It makes them super vulnerable to price undercutting at the general practitioner level.
And then there's the international threat, right?
Yeah.
Angelin.
Yes, Angeline is this really aggressive, low-cost entrant out of China, and they are rapidly expanding into Europe and the Asia-Pacific region.
And Align isn't just fighting them on pricing. They're locked in cross-border intellectual property warfare. The mid-2026 legal calendar is just stacked. Align faces a major patent trial against Straumann in June 2026.
Followed immediately by an International Trade Commission exclusion trial against Angeline in July.
And management flagged those IP trials as material risks to their global rollout, because defending a moat through endless litigation is incredibly expensive.
And if Align fails to secure that ITC exclusion order against Angeline, the influx of cheap generic aligners into premium markets could permanently compress the pricing power of the entire industry.
Okay, so we've covered the shifting product mix, the DSO volume floor, the 3D printing overhaul, and these brutal IP wars. Bringing all these sources together, we have to evaluate the final investment roadmap here. We started with the paradox. How does a company justify a 29 times earnings multiple with only 3 to 4% revenue growth?
The verdict really depends entirely on whether you view their efficiency engineering as a permanent solution or just a temporary band-aid.
Let's hear the bull case first.
The bull case, the buy-or-hold perspective, relies heavily on Elliott Management's discipline. If you believe the massive share buybacks, the guaranteed patient volume from those corporate DSOs, and their ability to expand operating margins to 23.7%, will successfully manufacture enough earnings growth to bridge the gap until interest rates fall, then the stock is a solid hold.
Okay, but what about the bear case?
The bear case looks at that exact same 29 times multiple and sees a massive trap. If you believe that structural ASP erosion, the drop in the average selling price is permanent and that bundled pricing from those massive conglomerates is going to slowly bleed Align's market share, then buying back stock is just rearranging deck chairs on the Titanic.
That is the multiple compression trap. If Wall Street eventually decides, hey, Align's hypergrowth days are just over for good, the market's going to re-rate them.
Exactly. They'll stop being valued like a high-flying software company and start being valued like a mature, slow-growth medical device maker. And if that multiple shrinks from 29 times down to, say, 15 times, the stock price collapses.
Regardless of how efficiently they manage their factory floor, it really is a masterclass in trying to change the engines on an airplane while it's mid-flight.
It really is.
So what does this all mean for you, the listener? Before we wrap up this deep dive, based on all these mid-2026 documents, what is the one overarching thread we should really be paying attention to going forward?
I think it connects back to the direct 3D printing technology and the software algorithms driving it. Align has spent over 2 decades accumulating the largest proprietary data set of digital jaw scans and tooth movements on the entire planet.
A massive data advantage.
Right. And if their AI algorithm eventually reaches near 100% clinical predictability and those direct fabrication printers execute that perfectly, you have to wonder if their true endgame is manufacturing plastic at all.
Wait, really? What else would it be?
Well, if the software becomes the actual clinician diagnosing and predicting outcomes better than a human doctor, Align's ultimate moat won't be dental patents. It will be an unassailable data monopoly on the biomechanics of the human jaw. They could just license that diagnostic engine to the broader healthcare sector long after the clear aligner market becomes completely commoditized.
Wow, a fascinating pivot from a plastic manufacturer to an AI healthcare data monopoly. It's something to think about. Rift defined, portfolio protected.